Welcome back. Today on the Byte-Sized Brief, we're going deep on Nokia, ticker symbol NOK. We're unpacking something I like to call the Phoenix Protocol. This is a legacy brand that has literally rewritten its entire DNA, and if they haven't been on your radar lately, well, it's definitely time to pay attention.
So let's dive right into what's happening right now. On April 29th, Nokia's stock suddenly popped over 10.4% in a single day. And to put that into perspective, the global telecom equipment sector has been, quite frankly, incredibly sluggish lately. We're living in a high interest rate environment, and major carriers have slammed the brakes on their 5G rollouts after that massive spending spree a few years back. Seeing a double-digit daily jump for a legacy telecom hardware provider in this kind of macro climate, it's almost unheard of. So today, we're going to break down exactly why the market is suddenly waking up to this stock, looking directly at the fundamentals from their first quarter 2026 report. And here is the number that really illustrates that momentum. Their first quarter comparable operating profits surged a massive 28% year over year, hitting 597 million euros. I mean, let that sink in for a second. 597 million euros in profit in just one single quarter. They absolutely crushed Wall Street's estimates, which were sitting around 520 million. In a historically heavy, capital-intensive hardware business like network infrastructure, seeing your operating profit jump by 28% means management is pulling some incredibly effective operational levers behind the scenes. But to really grasp why this beat is so significant, we have to talk about the elephant in the room. Because despite these massive financial wins, everyday retail investors are still incredibly skeptical. If you poke around retail trading forums, you'll see people asking things like, is Nokia really making a comeback in 2026, or are these just baseless rumors? And that skepticism makes sense because the general public still fundamentally misunderstands what the company actually does today. People hear Nokia and they instantly picture those indestructible brick phones from 2007, right? They're remembering playing Snake. But here's a crucial lesson when it comes to markets. Shifting the public perception of a legacy brand takes years. And that exact lag, that gap between reality and public perception, that is exactly where the mispricing opportunity usually sits for investors. Section 1. The Internet's invisible plumbing. Okay, to really understand Nokia's resurgence, we basically have to throw out our old ideas of their business model. They are not a consumer device company anymore. Today, they are the architects of the Internet's invisible plumbing. They don't make your cell phone. That brand is actually licensed out to a company called HMD. The new Nokia is laser-focused on enterprise and network infrastructure. They build these massive, high-end optical pipes. They build IP routing switches, which you can think of as highly sophisticated traffic cops, directing billions of data packets across the globe in milliseconds. They're even pioneering quantum-safe networks to protect data from future quantum computer hacks. Basically, they provide the gear that allows hyperscalers like Amazon, Google, and Microsoft to move unprecedented amounts of data securely and instantly. You can think of them as the premier provider of the Internet's optical backplane. So imagine an AI data center in Virginia needs to communicate instantly with another data center in Texas to train a massive large language model. Well, they need a physical, high-capacity highway to send that data. Nokia builds that highway. And this is absolutely critical because AI workloads require exponentially more bandwidth than traditional cloud computing. We're talking about massive parallel processing and real-time token generation, meaning exabytes of data continuously flowing between GPU clusters. Nokia has basically captured a highly defensible, incredibly lucrative business right at the base layer of the entire AI revolution. Section 2, Q1 2026 AI supercycle. So let's look under the hood of their latest quarter because we're seeing a massive shift playing out in real time. Their Q1 2026 report clearly beat forecasts, and they actually raised their full-year network infrastructure sales growth guidance from a modest 6 to 8% all the way up to 12 to 14%. Now, what's really fascinating here is that while top-line net sales only climbed a modest 4% to 4.5 billion euros, their gross margins expanded by a very healthy 320 basis points, hitting 45.5%. Operating margins jumped 200 basis points to 6.2%. You might be wondering, how does that happen? Well, it's because they are executing a strategic pivot away from low-margin commoditized hardware and moving toward higher-margin software and advanced optical tech. Software licenses cost almost nothing to replicate once they're developed, which leads to vastly superior margins compared to, say, bending metal for traditional cell towers. They're getting leaner, and they're getting significantly more profitable. But the real story here is hidden inside the segment breakdown. Their traditional mobile radio networks business was completely flat, 0% growth. But meanwhile, sales to AI and cloud customers literally exploded by 49%. In just this single quarter, Nokia brought in a staggering 1 billion euros in new orders from AI and cloud customers alone. Just think about that for a second. How many legacy telecom companies out there are actually securing billion-dollar AI contracts right now? Practically none. Nokia is successfully decoupling itself from the sluggish telco market and hitching its wagon directly to the AI rocket ship. Section 3. The Bull Case. And this massive pivot brings us straight to the bull case. It's exactly why Wall Street is suddenly paying very close attention, and why Bank of America recently issued a high-conviction upgrade for the stock, pointing to more than 30% upside. Analysts are highlighting 4 specific catalysts driving this. First, there's the successful integration of Infinera's high-end optical tech. Infinera specializes in advanced wave division multiplexing, which is basically a way to send multiple light signals down a single fiber to multiply capacity. It completely alters Nokia's DNA. Second, they are perfectly positioned to capture hyperscaler data center demand, which is expected to grow at a massive compound annual growth rate of 17 to 28%. Third is their status as a European trusted partner. This is a huge geopolitical tailwind. As Western nations increasingly ban Chinese vendors like Huawei over national security concerns, Nokia is quietly stepping in to grab that highly lucrative, sovereign-grade infrastructure market share. And fourth, a bleeding-edge partnership with Nvidia. And guys, that Nvidia collaboration is no small pilot program. It is a $1 billion deal focused entirely on AI RAN, or radio access network technology. This is genuinely a game changer. They're essentially working together to turn traditional, decentralized cell towers into powerful, edge computing AI data centers. Instead of a cell phone sending data thousands of miles away to a central cloud server to be processed, the cell tower itself becomes the brain. That near-instant processing speed is absolutely crucial for the future of autonomous driving, robotics, and smart cities. It puts Nokia right at the intersection of AI and connectivity for the next decade. But, as objective analysts, we can't just put on rose-colored glasses and cheer for the stock. We have to ask the hard questions. Nokia's optical and AI segments are obviously flying high, but what about that traditional mobile network business? Because that still makes up a massive chunk of their overall revenue. Section 4. The Bear Case. And this leads us directly into the bear case, which is a very serious one. The harsh reality is that global telecom capital expenditure is incredibly tight right now. Carriers spent heavily on 5G a few years ago, and now they are firmly pulling back. And when we compare Nokia against its fierce Nordic rival Ericsson, we see a pretty stark contrast in operational efficiency. Look back at the full year 2025. Ericsson delivered 17% operating margins. They pulled that off through ruthless cost discipline, strategic headcount reductions, and focusing their R&D on immediate cash flow positive projects. Nokia, on the other hand, lagged significantly behind at a much thinner 9% margin. Ericsson is out there proving that margins can actually expand even when global radio demand stays flat. Nokia still has to prove they can match that exact level of operational discipline. Furthermore, the core risks to Nokia's trajectory are very real. Global radio access network demand is completely flat. Their fixed networks division actually saw revenues decline by 13% in Q1. And perhaps most worryingly, they face the very real, multi-year scenario of a major U.S. carrier entirely ripping and replacing Nokia's radio equipment in favor of competitors. If a top-tier U.S. telecom completely drops Nokia, we aren't just talking about a minor earnings miss. We're talking about hundreds of millions in lost recurring maintenance revenue wiped directly off the balance sheet, putting immense pressure on their North American market share. Plus, to actually capture that AI optical market we talked about earlier, Nokia has to spend heavily on capital expenditures, estimated at nearly 1 billion euros this year alone. Section 5. Roadmap to the Future. Despite the harsh realities of this telco winter, Nokia's management is making some very aggressive bets. Their investments in optical hardware and AI are setting up several major catalysts moving forward. Looking ahead to the rest of 2026, keep your eyes peeled for the launch of their highly anticipated AI RAN customer trials later this year. We also really need to watch the scaling of their new indium phosphide manufacturing facility in San Jose, California. That's a crucial strategic move, because having a domestic U.S. supply chain is often a strict requirement for winning those massive U.S. government and defense contracts. Then, looking to mid-2027, they'll launch sampling for their new optical digital signal processors, tech that claims to reduce the total cost of ownership by up to 70% for data centers. And all of this builds a bridge to 2028, where we'll see 6G entering its conceptual phase right as AI hyperscaler demand fully matures. So, what's the bottom line here? The numbers clearly show that Nokia is no longer just that nostalgic cell phone company from the 2000s. They are a critical infrastructure player aggressively pivoting to capture the AI supercycle. But the ultimate question remains, Is this massive growth in their optical and cloud segments going to be sustainable enough to overcome the heavy drag of a stagnant traditional telco market? That wraps up today's deep dive explainer on Nokia. For a sharper, more candid discussion, join us on the full audio explainer. Drop your questions, your takes, and your predictions in the comments below. We read every single one. Thanks for learning with us today.